I found something in the data that nobody wants to talk about. Something that looks almost exactly like what I saw in 2005 when I started betting against the housing market. Something that could trigger the next banking crisis. And when I say nobody wants to talk about it, I mean the banks do not want you to know. The regulators are pretending it does not exist. And Wall Street is too busy making money packaging and selling these loans to care about what happens next. I am talking about the auto loan market. $1.6 trillion in outstanding debt. Loans being made to people who cannot afford them. Securities being created and sold to investors who do not understand what they own. Delinquencies rising to levels not seen since the financial crisis. And banks, particularly regional banks already weakened by other problems, sitting on exposure that could wipe out their capital when this unravels. This is the auto loan crisis that will crash banks. And if you have money in the wrong places, if you own the wrong stocks, if you are not paying attention to what I am about to show you, you could suffer devastating losses. Let me take you back to 2005 because the parallels between what I saw then and what I see now are so precise that it sometimes feels like I am reliving the same nightmare. In 2005, I started examining the mortgage market in detail. Not the headlines, not the analyst reports, not the conventional wisdom. The actual loan-level data. I was reading the prospectuses for mortgage-backed securities, documents that were hundreds of pages long, filled with technical details that almost nobody bothered to read. What I found horrified me. Loans were being made to borrowers with no income verification, no down payments, adjustable rates that would reset to unaffordable levels. The underwriting standards had completely collapsed. Lenders were not asking whether borrowers could repay. They were asking only whether they could sell the loan to someone else before it defaulted. I tried to warn people. I talked to investors, to journalists, to anyone who would listen. Almost everyone thought I was crazy. Housing prices always go up. They said the models show these securities are safe. The ratings agencies have blessed them with AAA ratings. Who are you to question the entire system? I was right. They were wrong. And millions of people lost their homes, their savings, their retirements, because the people in charge refused to see what was obvious in the data. Today, I see the same patterns in auto lending, the same deterioration in underwriting standards, the same extension of credit to borrowers who cannot repay, the same packaging of bad loans into securities sold to investors who trust the ratings, the same willful blindness from regulators and industry participants who profit from the status quo. The auto loan crisis is not coming. It is already here. The question is not whether it will cause damage. The question is how much damage and who will be caught holding the losses when the music stops. Let me walk you through what I have found, because the data is damning and the implications are severe. The first thing you need to understand is the sheer scale of the auto loan market. Americans owe over $1.6 trillion on car loans. That is larger than credit card debt. It is second only to mortgages and student loans among consumer debt categories. This is not a niche market. This is a systemically significant pool of debt that touches almost every financial institution in America. The growth in this debt has been extraordinary. In 2010, total auto loan balances were about $700 billion. They have more than doubled since then, adjusted for inflation, adjusted for population growth. Americans are borrowing far more to buy cars than at any point in history. This growth was not driven by Americans becoming wealthier and buying more cars. It was driven by lenders loosening standards and extending larger loans to borrowers who could not previously qualify. The same dynamic that inflated the housing bubble inflated the auto loan bubble. Easy credit masked underlying weakness until the weakness became impossible to ignore. The second thing you need to understand is how loan terms have stretched to make unaffordable cars appear affordable. In 2010, the average auto loan term was about 60 months, 5 years. Today, the average has stretched to over 70 months, nearly 6 years. Loans of 84 months, 7 full years, are now common. Some lenders offer 96-month loans, 8 years to pay off a depreciating asset. Think about what this means. A car is not like a house. A house might appreciate over time. At least historically, a car depreciates from the moment you drive it off the lot. A new car loses 20 to 30% of its value in the first year. It loses another 15% in the second year by year 5. Most cars are worth a fraction of their original price. When you stretch a loan to 7 or 8 years, the borrower is underwater almost immediately and stays underwater for years. They owe more than the car is worth. If they need to sell the car, whether because of job loss, illness, divorce, or just changing circumstances, they cannot. They owe more than they can get for it. They are trapped. This negative equity problem is massive. Roughly a third of all car owners who trade in their vehicles owe more than the trade-in value. That negative equity gets rolled into the new loan, starting the cycle again with even more debt. Borrowers are not paying down their auto debt. They are accumulating it, rolling it forward, digging deeper into a hole they may never escape. The third thing you need to understand is the deterioration in borrower quality. Subprime auto lending, loans to borrowers with credit scores below 620, has exploded over the past decade. These borrowers pay interest rates of 15, 18, even 25%. The lenders know many will default, so they charge rates high enough to profit even after accounting for losses. But the losses are mounting faster than the models predicted. Delinquency rates on subprime auto loans have exceeded 8% higher than at any point since the data began being tracked. Default rates are approaching levels seen only during the worst of the 2008 crisis, and we are not even in a recession. When I dig into the loan level data, I see patterns that terrify me. Loans being made to borrowers with debt-to-income ratios of 50% or higher. Loans with no income verification, just like the stated income mortgages that blew up in 2008. Loans where the monthly payment represents a third or more of the borrower's take-home pay. These loans cannot possibly be repaid under normal circumstances. They can only survive if everything goes perfectly for the borrower for 7 or 8 years straight. Nothing goes perfectly for anyone for 7 or 8 years straight. Now, let me explain how this auto loan mess connects to the banking system and why the banks most vulnerable to this crisis are the same banks already weakened by other problems. Auto loans are originated through several channels. The captive finance arms of automakers like Ford Motor Credit and GM Financial originate a large share. Banks, both large and regional, originate another significant share. Credit unions originate some, and specialized subprime lenders, companies focused specifically on lending to borrowers with poor credit, originate the riskiest loans. Many of these loans do not stay with the original lender. They are packaged into securities called asset-backed securities and sold to investors. This is the same securitization process that was used for mortgages, the same process that spread risk throughout the financial system before 2008. The buyers of these securities include pension funds, insurance companies, money managers, and banks themselves. They buy because the securities offer higher yields than government bonds, and because the ratings agencies have blessed many of these securities with investment-grade ratings. But the ratings are based on models, and the models are based on assumptions that may not hold. The models assume delinquency rates will stay within historical ranges. They assume recovery rates when loans default will match historical averages. They assume the economy will not enter a severe recession. If any of these assumptions prove wrong, the securities will perform far worse than expected. Investors who thought they owned safe, income-producing investments will discover they own pools of defaulting loans on depreciating assets. I have been studying the structure of these securities the same way I studied mortgage-backed securities 20 years ago. What I see concerns me deeply. The subordination levels, the cushion of losses that senior bondholders are protected against, are thin relative to the risks. The assumptions embedded in the ratings are optimistic relative to current delinquency trends. The securities are mispriced relative to their actual risk. This creates the potential for sudden, sharp losses when investors realize the truth. The repricing of mortgage-backed securities in 2007 and 2008 was not gradual. It was a cascade, as one investor's selling triggered margin calls for others, which triggered more selling, which triggered recognition that the entire market had been mispriced. I see the potential for a similar cascade in auto loan securities, not on the same scale as mortgages, The market is smaller but significant enough to cause serious damage to financial institutions with concentrated exposures. Now, let me tell you which banks are most vulnerable, because this is where the warning becomes specific and actionable. Regional banks have significantly higher exposure to auto lending relative to their size than the largest banks they originated aggressively during the boom years, competing for market share by loosening standards. They retained many of these loans on their balance sheets rather than securitizing them. And they lack the diversification that would allow them to absorb losses without threatening their capital. Several regional banks have auto loan portfolios representing 10, 15, even 20% of their total assets. If losses on those portfolios reach levels consistent with current delinquency trends, the banks would face capital impairment. If losses reach levels consistent with a recession scenario, some of these banks would become insolvent. These are the same regional banks already struggling with unrealized losses on their bond portfolios, already facing deposit flight to larger institutions, already dealing with commercial real estate exposure. The auto loan problem is not isolated. It is another vulnerability layered on top of existing vulnerabilities. The cumulative stress could overwhelm institutions that might survive any single problem. I am not going to name specific banks, because that would be irresponsible. A bank run triggered by my comments could become self-fulfilling. But I will tell you how to identify vulnerable institutions. Look for banks with above-average auto loan concentrations in their loan portfolios. This information is disclosed in regulatory filings and annual reports. Look for banks operating in regions with high subprime auto lending activity. Look for banks that grew their auto lending rapidly during 2020 and 2021 when standards were loosest. Look for banks already showing stress in other areas, declining stock prices, credit rating downgrades, regulatory actions. If your bank has these characteristics, or if you own stock in banks with these characteristics, you need to take action. The auto loan losses are coming. The only question is which institutions will absorb them. Let me share what the current data shows, because the deterioration is accelerating faster than most people realize. Delinquencies on auto loans payments more than 30 days late have risen to over 7% across all credit categories. For subprime borrowers, the rate exceeds 8%. These are the highest levels since 2010, when the economy was still recovering from the financial crisis. Defaults loans where the lender has given up on collection and charged off the balance are running at nearly 3% annually. On a portfolio of $1.6 trillion, that is nearly $50 billion in losses per year flowing through the system. Those losses have to be absorbed somewhere. By lenders, by investors in securities, by insurers who guaranteed the debt. Repossessions are surging. Over 2 million vehicles were repossessed last year. The highest number since the financial crisis. Repossession lots are overflowing with inventory. The vehicles being repossessed are worth less than the outstanding loan balances, creating deficiency balances that borrowers still technically owe but will never pay. The recovery rates on defaulted loans are declining. When a lender repossesses a car and sells it at auction, they rarely recover the full loan balance. Currently, lenders are recovering around 40 cents on the dollar for repossessed subprime vehicles. That means 60% of the loan balance is lost permanently. As more vehicles flood the auction market, prices fall further, and recovery rates will decline more. This is a self-reinforcing cycle. Falling used car prices make more borrowers underwater, increasing defaults. Increased defaults flood the auction market with more vehicles, pushing prices down further. Lower prices reduce recovery rates, increasing losses. Higher losses impair lender capital, restricting new lending, slowing auto sales, pushing prices down further still. We are in the early stages of this cycle. The full effects have not yet been felt. But the trajectory is clear and the mathematics are unforgiving. Now, let me explain why this crisis will be worse than the official projections suggest. Because the models being used to estimate losses are fundamentally flawed. The models assume that the current environment resembles past periods when delinquencies rose. They assume the same recovery rates, the same cure rates for delinquent loans, the same relationships between unemployment and default. But this cycle is different in important ways that make the standard assumptions too optimistic. First, the loan terms are longer than ever. Borrowers are underwater for longer, giving them more time and more reasons to default. The historical data does not include a period of widespread 7- and 8-year loans. The models are extrapolating from an era of shorter loans with different dynamics. Second, the vehicles themselves are different. Modern cars are more complex and more expensive to repair. When something major breaks on a 7-year-old car with 4 years of payments remaining, the borrower faces a choice between expensive repairs on a car they do not own and stopping payments on a car they cannot afford to fix. Many will choose to stop paying. Third, the negative equity problem is worse than ever. More borrowers are more deeply underwater than at any point in history. The rolled negative equity from previous loans has compounded. Some borrowers owe $10,000, $15,000, even $20,000 more than their vehicles are worth. They have no path to escape except default. Fourth, the economy is more fragile than the models assume. The labor market is showing cracks. Inflation has eroded real wages. Savings accumulated during the pandemic have been spent. Consumers are stretched thin, and auto loan payments compete with rent, food, and other necessities. When I run scenarios that account for these factors, the loss projections are significantly higher than the consensus estimates, not slightly higher, materially higher, high enough to threaten the solvency of banks with concentrated exposure, high enough to cause significant losses for investors in auto loan securities, high enough to matter for the broader financial system. Let me tell you what I am doing about this. Because understanding the problem is only valuable if it informs action, I have positioned my portfolio to benefit from the coming auto loan crisis. I own protection against specific institutions with high auto lending exposure. I have short positions in securities that will decline when auto loan losses materialize. I am avoiding any exposure to regional banks that might be affected. For individuals who cannot take the kinds of positions I take, the defensive actions are straightforward. If you have deposits at regional banks with significant auto lending exposure, consider moving those deposits to larger, more diversified institutions. The auto loan problem alone might not cause your bank to fail, but combined with commercial real estate losses, unrealized securities losses, and deposit flight, it could be the straw that breaks the camel's back. If you own stock in banks with high auto lending concentrations, consider reducing or eliminating those positions. The market has not yet priced in the severity of the coming losses. When it does, these stocks will fall significantly. If you own bond funds that include asset-backed securities, examine what those funds actually hold. Many investment-grade bond funds include auto loan securities. When losses materialize and ratings get downgraded, these funds will face selling pressure and price declines. If you are considering buying a car, understand that the lending environment will tighten significantly over the next few years. Getting pre-approved now while credit is still available might be prudent if you anticipate needing a vehicle, but also consider whether you really need a new car, whether a used car might serve your needs, whether you are taking on debt you might struggle to repay. Let me address the response I anticipate from the industry, because I have seen this movie before. The auto lenders will say that their underwriting is sound, that they have learned from past mistakes, that their models account for various scenarios. They said the same things about mortgages in 2006. The models did not account for what actually happened. The ratings agencies will defend their ratings, pointing to subordination levels and structural protections. They defended their mortgage ratings too, right up until they had to downgrade everything overnight. The regulators will say they are monitoring the situation, that banks have adequate capital, that the system is resilient. They said the same things before every financial crisis in history. They are always monitoring. They never act until it is too late. The banks will say their auto loan portfolios are performing within expectations, that delinquencies are manageable, that reserves are adequate. They will say this right up until they announce massive loss provisions and capital raises. I have no ability to change what these institutions say or do. But I can share what I see in the data, what I believe will happen, and how I am positioning myself accordingly. The auto loan crisis will not be as large as the mortgage crisis. The market is smaller, the securities are less complex, the leverage is lower, but it does not need to be as large to cause serious damage. For banks already weakened by other problems, the incremental stress from auto loan losses could be fatal. For investors in auto loan securities who thought they owned safe investments, the losses will be painful. For the broader economy, the contraction in auto lending will reduce vehicle sales, hurt automakers, and eliminate jobs. The contagion effects are what worry me most. Financial crises spread through confidence channels as much as through direct losses. When depositors see one bank fail due to auto loan losses, they will wonder about their own bank. When investors see one security get downgraded, they will reassess their entire portfolio. The panic, once it starts, does not stay contained to the original source. I saw this in 2008. The mortgage problems were visible for years before the crisis, but the crisis itself happened in weeks. The confidence break was sudden and complete. Institutions that seemed fine on Monday were seized by Friday. The speed was terrifying. I expect a similar dynamic with auto loans. The problems will build gradually, visibly for those willing to look. Then something will trigger recognition, some bank failure or security downgrade or headline that captures attention. And then the adjustment will be rapid and violent. I do not know exactly when this will happen. I did not know exactly when the mortgage crisis would hit either. I was early, painfully early, years early. Being right eventually is small comfort when you are wrong in the meantime. But I know the mathematics. I know that loans being made today cannot be repaid by the borrowers receiving them. I know that losses will mount until they are recognized. I know that recognition will be sudden and the consequences will be severe. The auto loan crisis that will crash banks is not a prediction about some distant future. It is a description of current conditions that have not yet been acknowledged. The delinquencies are already elevated, the defaults are already rising, the losses are already accumulating. The only thing missing is widespread recognition of what the data clearly shows. That recognition is coming. When it arrives, the banks with concentrated exposure will face severe consequences. The investors who own their stocks and bonds will suffer losses. The depositors who trusted these institutions with their savings may find themselves caught in failures they did not anticipate. I have warned you about what I see. I have explained the data, the dynamics, the vulnerabilities. I have told you which types of institutions are most at risk and what actions you might consider. The rest is up to you. I hope I am wrong. I hope the auto loan market somehow works itself out without crisis. I hope the banks find ways to absorb their losses without failing. I hope the investors somehow avoid the repricing that seems inevitable. But I do not invest based on hope. I invest based on analysis. And my analysis says the auto loan crisis is real. It is here. And it will crash banks that are not prepared for what is coming. Pay attention to the data. Do not trust the reassurances from people who profit from your complacency. Take protective action while you still can. The warning signs are everywhere for those willing to see them. I have seen them. Now you have too. What you do with this information will determine whether you are among the protected or among the casualties when the crisis fully arrives. The auto loan crisis is coming. The only question is whether you will be ready when it does. But let me go deeper on the specific mechanics of how this crisis will unfold, because understanding the sequence helps you recognize when the cascade is beginning. The first phase is already underway. Delinquencies are rising, but losses are being managed through loan modifications, payment deferrals, and accounting discretion. Lenders are extending the runway, buying time, hoping that economic conditions improve before the runway ends. This is the denial phase. Everyone knows the problems exist, but nobody wants to be the first to acknowledge them publicly. The second phase begins when a major subprime auto lender fails or announces catastrophic results. There are several candidates, companies that specialized in deep subprime lending during the boom years, and now hold portfolios of toxic loans. When one of these falls, attention will focus on the broader market. Analysts who ignored the sector will suddenly discover the data that has been available all along. The third phase is contagion to the securitization market. Investors who own auto-backed securities will reassess their holdings, spreads will widen, prices will fall. The securities that were trading near par because everyone assumed they were safe will gap down as assumptions are revised. Rating agencies will begin downgrade cycles, always late, always reactive, but adding to the selling pressure. The fourth phase is when banks begin announcing increased provisions for auto loan losses. The provisions will be larger than expected because the losses were being hidden through accounting treatment. Investors will discover that the exposures they thought were limited were actually much larger. Bank stocks will fall, credit default swaps on bank debt will spike, the narrative will shift from isolated problems to systemic concerns. The fifth phase is potential bank failures. Regional banks with concentrated auto exposure and inadequate capital will not survive the combination of auto losses, commercial real estate losses, and unrealized securities losses. Regulators will be forced to intervene. Deposit insurance will be tested. The systemic risk I have been warning about will become undeniable. Let me also explain why the regulatory response will be inadequate, because this is another area where history is instructive. Bank regulators face a fundamental problem. Their job is to identify problems before they become crises. But when they identify problems publicly, they risk creating the very crisis they are trying to prevent. A regulator who announces that a bank has dangerous auto loan exposure might trigger a run that destroys the bank. So regulators tend to work quietly, confidentially, hoping to manage problems without public acknowledgement. This creates a gap between regulatory awareness and public awareness. The regulators may know that certain banks are vulnerable. They may be conducting examinations and issuing private warnings. But the public, including depositors and investors, remains uninformed. When the crisis finally becomes public, it arrives as a shock even though regulators knew about the problems months or years earlier. The other problem with regulatory response is capture. The people who regulate banks often come from banks or plan to work at banks after their regulatory tenure. They socialize with bankers. They absorb the industry perspective. They are reluctant to impose costs on institutions they may soon work for. This does not mean regulators are corrupt, but their perspective is inevitably shaped by their relationships and career incentives. During the mortgage crisis, regulators had ample warning. They received presentations about deteriorating underwriting. They saw the data on stated income loans and high loan-to-value ratios. They chose not to act aggressively because the banking industry was profitable, the economy was growing, and intervention seemed unnecessary or counterproductive. The same dynamic exists today with auto loans. Regulators have access to the data I have described. They can see the rising delinquencies, the extended loan terms, the deep subprime originations, yet they have not acted to curtail the practices that created the problem. They will be blamed when the crisis hits, but by then it will be too late to prevent the damage. Let me also discuss the role of the captive finance companies, because they add a dimension of risk that many people overlook. The major automakers, Ford, General Motors, and others, have finance subsidiaries that originate a significant share of auto loans. These captive finance companies serve multiple purposes. They help automakers sell vehicles by providing financing that might not be available elsewhere. They generate profit from the spread between their funding costs and the rates they charge borrowers. And they provide a release valve for inventory when sales slow. During economic downturns, the captives often become more aggressive in their lending to support vehicle sales. They originate loans that third-party lenders will not make. They offer terms that are economically questionable but serve the strategic purpose of moving metal. This creates a conflict between sound lending and the parent company's need to maintain sales volumes. The captives also have significant exposure to residual value risk on leased vehicles. When lease terms expire, the vehicles return to the captive at predetermined residual values. If actual used car prices are below those residual values, the captive absorbs the loss. The decline in used car values that I discussed earlier creates significant residual value exposure across the captive finance companies. If auto sales decline sharply, the automakers face a dilemma. They can tighten lending standards, which reduces sales and hurts their core business, or they can maintain aggressive lending, which increases losses at the finance subsidiaries. Either choice has negative consequences in practice. They usually choose to support sales, absorbing losses at the captives until those losses become unsustainable. This dynamic means that the auto loan crisis is linked to the health of the automakers themselves. Severe finance subsidiary losses could impair automaker capital. Distressed automakers could face credit rating downgrades that increase funding costs for the finance subsidiaries. The interconnections create feedback loops that amplify stress. Let me share some specific numbers that illustrate the scale of potential losses, because quantifying the risk helps calibrate the appropriate level of concern. If delinquencies continue their current trajectory, and that trajectory becomes defaults at historical conversion rates, I estimate total auto loan losses over the next 3 years could reach $150 billion. Not all of those losses fall on banks. Some fall on the captive finance companies, some on credit unions, some on investors in securitizations. But banks could absorb $40 to $50 billion of direct losses, plus additional losses through credit facilities and securities holdings. For context, the regional banking sector has total equity capital of roughly $300 billion. A $40 to $50 billion loss would represent 15% of sector capital. That is a significant impairment. It would force capital raises, dividend cuts, and in some cases failures. The losses would not be distributed evenly. Some banks have minimal auto exposure, others have concentrated exposure representing substantial portions of their loan portfolios. The banks with concentrated exposure could see losses that exceed 20 or 30% of their capital. At that level, solvency becomes questionable. These are not worst-case numbers. These are base-case numbers assuming the economy avoids recession. In a recession scenario, job losses would accelerate defaults. Used car values would fall further. Recovery rates would decline, and total losses could reach $200 billion or more. The recession scenario would be devastating for the most exposed institutions. Now let me explain why the auto loan market matters beyond the direct losses, because the second-order effects could be substantial. Auto loans are central to the American economy. Vehicle sales represent a significant share of consumer spending. Auto manufacturing employs hundreds of thousands of workers directly and millions more indirectly through suppliers and dealers. A contraction in auto credit would reduce vehicle sales, hurt automakers, and ripple through the economy. When subprime borrowers can no longer get auto loans, they cannot get to work. They cannot take jobs that require transportation. They cannot participate fully in the economy. The credit contraction has real effects on real people that extend beyond the financial losses to lenders. The used car market would be severely affected. Repossessions flood the market with inventory prices decline. Consumers who were counting on trade-in values to fund new purchases find themselves unable to afford vehicles. Dealers who depend on used car sales see their businesses contract. The ecosystem effects are broad. The securitization market effects extend to other asset classes. Investors who lose money on auto-backed securities become cautious about all asset-backed securities. Spreads widen across the board. Funding costs increase for all types of consumer lending. The contagion from auto loans could affect credit cards, student loans, equipment finance, and other securitized products. And the confidence effects are hardest to quantify but potentially most significant. If regional banks begin failing due to auto loan losses, depositors at other regional banks will become nervous. Even banks with minimal auto exposure could face deposit flight as customers decide that safety requires moving to the largest institutions. This contagion through confidence channels is how localized problems become systemic crises. I want to emphasize that I am not making a prediction about timing. I cannot tell you that the crisis will hit in 6 months or 12 months or 24 months. Financial systems can absorb stress longer than seems possible. The accounting games can extend longer than expected. The economic conditions can remain supportive longer than models predict. What I can tell you is that the fundamental conditions for crisis exist and are worsening. The loans being made cannot be repaid by the borrowers receiving them. The securities backed by those loans are rated based on assumptions that will not hold. The banks holding those loans and securities have inadequate capital for the losses coming. The regulators who should be preventing this are looking the other way. Eventually, these conditions produce crisis, not because of pessimism or fear-mongering, but because of mathematics. Loans that cannot be repaid will not be repaid. Losses that are hidden eventually emerge. Capital that is inadequate eventually runs out. My track record on these calls is far from perfect. I have been early many times, I have been wrong occasionally. But on the big calls, the ones where the data was overwhelming and the patterns were clear, I have been right. The mortgage crisis was obvious in the data. The auto loan crisis is obvious in the data. I have done my part by sharing what I see. The analysis is yours to verify or reject. The action is yours to take or not take. But do not say you were not warned. Do not claim that nobody saw it coming. The warning is here, documented, available to anyone willing to listen. The auto loan crisis will crash banks. The only questions are which banks and when. Position yourself accordingly.